Okay, so interest rates are not one size fits all. Please don't assume that everybody gets the same rate. That's just not how they work. Here's what actually impacts and decides your interest rate. There's a lot of them. Number one is the county that you buy in. Every county has its own pricing adjustment. The differences here are usually marginal, if any. Number two is occupancy. If you're going to own the home as your primary residence, that's given the best pricing than if you're going to buy it as a vacation or second or rental or investment property home, then those homes are going to be priced higher than an owner occupancy primary residence would be priced. Then there's a home type. Condos can have higher pricing than single family and townhomes, especially high-rise condos. Then there's your credit score. Obviously, the better your score, the better your pricing. And once you hit 740, you usually can't get any better of an interest rate. Then there's the number of borrowers can affect your pricing. Now this can only be a factor for calculating mortgage insurance. 2 borrowers are better than 1 for this instance. Then there's your loan type. You can either do VA loan, conventional conforming, jumbo, FHA. They have different interest rates. Then there can be a down payment affecting your pricing. The larger down payments often have incentives for the rate. Then there's a loan amount. Once loans go above or below certain amounts, they can get hit with pricing increases or be given pricing reductions. For example, loans below $125,000 and $75,000 have, believe it or not, higher pricing than loans above those numbers. Another example, in 2022, if your loan amount goes above $647,200, then it can bump up the pricing again if that's going to stay an FHA or a VA or a conventional conforming loan. Then there's the loan purpose. Refinances have higher pricing than purchases. And within that, cash out refinancing usually has a higher price than the standard typical refinance. Then there's a loan length. Terms of 20 years or less, especially 15 years or less, have better pricing than the 30-year terms. Then there's the fixed versus ARM pricing. Adjustable rate mortgages can have a lower introductory period than a fixed rate loan would have. And then there's a financial market. This moves interest rates up and down every day. So we're finally done. And now you know why if you call me and ask what the rate is today, I can't just spit it out off the top of my head. I'm not Stephen Hawking or anything. And there's just too many things affecting it for me to be able to drop that and give you something that's honest. I don't want to just throw something out there since there's so many variables. It's very easy that it could be wrong before I enter all those into our little calculator and then give you something. So, as I've said in earlier episodes, rates are only relevant to you when you are under contract on a home that you can then lock. So, that's interest rates, and thank you for watching.